So the first one, if you see in make or buy problems, okay, the key point is you have to ignore the fixed cost, okay, because they are assumed to be recovered. So do not add fixed cost here, okay. You don't need to consider fixed cost. So just read this question, you will get an idea. So this product, if made in the company, it is 6, and if it's made in the bought, it is 5.6. So should we like buy or make or buy? So it seems that it is better to buy the product, okay, but let's see. Okay, so the first question is, should we make or buy? So we'll just so this is the first question. Should we make or buy? Okay, so in the market price is 4.6. Okay, so we have two questions here. So we'll start. See, per unit, we can find out per unit or per amount. That won't be a problem. Per unit wise, the relevant costs are 2 and 2.5, and the other variable cost is 0.5. These are the variable costs. Okay, so the total cost of manufacturing is only 5. It's not the 6, because we have to ignore the fixed cost. So the buying cost is now how much? 5.6. 5.6. Now the suggestion would be, okay, as making cost is lower than buying, it is better to buy. Sorry, it is better to make. So that's about the first one. And so if the same product is made for 4.6, then if we could buy it for 4.6, then we should buy uh, that product, because our total make cost itself is 5, right? And if you could buy it at 4.6, that seems to be much better. So we can say, as making cost is higher than buying, it is better to buy. So we'll start from here. This is the second problem. So you can read along. Okay, so they are telling that to produce the product it takes 15. So of course you have to ignore the fixed cost because the company seems to be producing a lot of products. So they are producing only this is part 47 alone. So they are producing a lot of product, and our assumption here is note fixed cost is already recovered by the company. So the cost of making is going to be 10, and we have two cases here. So we have case A. We'll start from that. Case A is it is possible to hire out the facilities at rupees 30,000 per month. Okay, so cost of making is 10 per unit, and in terms of amount it's going to be 10 into 20,000. So that comes to 2 lakhs, right? Now the case tells you if we are not going to produce the product, we can let out the facility for rent, and we'll also get another 30,000. Okay, so first we'll see like what is the cost of purchase. So the cost of purchase is 12 rupees per unit, or 12 rupees per unit. So that comes to 2,40,000, right? It comes to 2,40,000. But we have to pay this 2,40,000 to get the units, but we can get an income. So from this cost we will reduce the income from rent. So income from rent would be 30,000 per month. So now the effective purchase cost is 2,10,000. So we have to compare this 2,10,000 with this 2 lakh. Okay, so still it seems to be costly, even though you can buy a 12 and you will get an additional rent of 30,000. Still it seems to be costly. So our suggestion would be make. Okay, so let's see the other alternative. The other alternative is B. So B says, see here also it's going to be the same purchase cost. So the purchase cost is going to be the same, but I don't think there's going to be any idle facility. But they say that this idle facility could be used to produce 5,000 units per month of a product at a variable cost of 40, and which could be sold at a price of 50. So this idle facility could be used to produce some other product. Okay, so we can buy part 47 and we can use this facility to produce another product called as X. So we can say that it is less income from X. Okay, so how much would be the income? So the income will be 50 minus 40, 50 minus 40, right? So that's a income. So we'll get 10 rupees per unit we'll get. So we can't put that 10 outside. Okay, we can't put it there because 10 we have to only put it here. So we will remove it from here. This 10 rupees item, how many items we can produce? We can produce only 5,000. So 5,000 you can produce, and that becomes 50,000. Now the effective purchasing will be only 1,90,000 because you have to pay 2,40,000 for the buying from outside. This additional facility can be used to produce X, which has a contribution of 10, and 5,000 units could be produced. So 50,000 is the income. So 2,40,000 we are have to purchase the part X, and 50,000 is the income that we'll get from selling X, and our total effective cost is only 1,90,000. So what is our suggestion? If we produce, it is 2 lakhs. If we buy, it's our effective purchase cost is only 1,90,000. So that's what you have to do. So that's about this problem. Okay, we'll move on to the next one. So we'll read from this problem. So the requirement is advise the management as to the action they should take. Okay, so it's an again make or buy problem only. So we have to ignore the fixed cost, and we'll read the question. You can read along the cursor. So we'll start with the discontinuing problem. So what is the discontinuing problem? Discontinuing is, for example, if a company has like 4 products, so like in this case, the company might feel that it is unprofitable to have one product, and they will try to stop it. So our consideration is whether we should stop the product or should we still produce the product. Okay, so that is the kind of decision that we are required to make. So first we'll read the question, and then we'll try to find out what how to solve it. Okay, Okay, so the first question is, we are going to continue producing WXYZ, and we have to produce in a management accounting format. What's the format? It's very simple. Show sales, then variable cost separately, then find out contribution, then find out fixed cost, and then find out the profit. Okay, so show it in that manner. Then, okay, so the second point is, the production manager says that let's stop producing Z and we'll produce more amount of Y instead of Z. Okay, so for that we have to prepare a statement. I think once we prepare a statement for the this part of the question, the B1 part of the question, I think we could even simply copy and we could change a few numbers here and there. So let's see B2. So the B2 question is a theory question where we just have to explain whether to continue or discontinue the product. And C question is, okay, if we are going to discontinue a product, what are the non-financial things that we have to take into account? Okay, so these are the questions here. So I think we can first type it so that it is quite easier for us to work also. So let's find out the current profitability. So we have the four products. Let's read the statement. We'll get an idea. So these are the items we have: sales, cost of sales, gross profit, overhead, selling and administration, and net profit. So this looks like mostly like financial accounting explanation. So we don't need to have this kind of working. We need to bifurcate the expenses on variable cost and fixed cost manner. Okay, this kind of split is useless. Okay, so we'll see. Okay, so they are going to stop the product Z. Of course, it is making a loss. Okay, so that's why they are stopping it. And by stopping it, they feel that it is better to increase Y by 40%. It will increase by 40%. So again, they have given some information. So product W, X, Y, Z are there. Variable cost is given. Fixed cost is given. Okay. See, this kind of a split is what we want. Okay. So from the earlier table, we'll get the sales data and cost of sales data. Mm, Okay, I think they have split the cost of sales only like this. So 16 is split, 8,000 here, that is also split, 22,000 is split, and 10,000 is also split. Okay, so the split is actually the cost of sales. Okay, they have not given data till for selling and administration till now. So let's see and we'll work it out. Okay, so he says out of this 31,400, there is a fixed cost of 20,000, which is not for any product. It is for the common benefit of all the products. So, and which has been apportioned to each product on the basis of sales value. So, this 20,000 has been divided and has been added to all these fixed costs on the basis of sales values. If the quantity of any product increases by 25%, then the specific fixed production cost will also go up by 30%. Okay, so what is the specific fixed production cost? So within that we might have a specific. So the selling overhead comprises a fixed cost of 5,000 pounds per product plus a variable cost which varies in proportion to the sales value. So there is a 5,000 amount within the selling overheads. Okay, selling overheads is here. So the balance, he says it's variable, which is related to the sales. The fixed cost is not specific to any product, but the sales director believes that it should be shared equally by the 4 products. So the fixed cost is like not attributable to any product, but it is overheads. The administration cost is a central overhead cost. It is not affected by the products made. Okay. So first, what we'll do, we'll try to find out the we'll create a format, and the format would, I think, should be like this. So the first one is sales, should be sales, and thereafter it should be the cost of sales. So cost of sales, we can divide it into two parts. One is the variable part, other one is the fixed part. Okay, I think we'll put it as FC. Okay, so we can show the fixed cost, okay, at a place where it is lower. And what else we have? We have then selling. Okay, so selling also. So the fixed cost itself, we have to divide it on the basis of relevant fixed cost and common. Okay, common fixed cost. So we have to divide it in on two bases. So we'll finish each chapter, sorry, each part one by one. So we'll start from the sales, because sales is the only number which is not much affected. Okay, so we have variable cost. So variable cost, I think directly we can put. There's no notes or anything for that. $4,800, $1,600, $13,200, and last one is 5,000. Okay, so let's see whether they have given any other notes. So the total fixed costs, okay, figure includes 20,000. So this amount, this 31,400 includes 20,000, which is not specific to any one product. Okay, so we can put another column called as total. So the the cost of sales includes a fixed cost which is coming under head, which is common fixed cost. Okay, so that common fixed cost is 20,000. Done. So what about the other cost? So the other cost, and which has been apportioned to each product on the basis of its sales value. Okay, so and which has been apportioned to each product on the basis of sales value. So this 20,000 has been included in this fixed itself, and that has to be removed. Okay, so we have to find out that. I think we have to create a working note for that. So the working note should have, this is the working note, the cost of sales and the fixed cost. So we have again W, X, Y, Z. So the fixed cost which is given, is 11,200, 6,400, 8,800 and 31,400. From this we have to separate the common fixed cost. Okay, we have to separate the common fixed cost. So less so how do we separate it? So the total amount seems to be, this total amount is 20,000, but that 20,000 amount, okay, that 20,000 amount, so we can put it as a total, is split on the basis of the sales value. Okay, so if you say if you take it as per unit, it would be 20,000 divided by the total sales. Total sales is 1 lakh. So each okay, 0.2 is the common fixed cost per unit. Okay, so per unit it is 0.2, or so units is not given, so we can't do it in units. What we could do is 20,000 is a fixed cost divided by 1 lakh, so it is 0.2 per dollar sales value. Okay, for every dollar sales value they take 0.2. so our consideration is like very simple here. We have to take 0.2 and multiply by the sales amount. So it is 30,000 here. The same way you have to put for all the products: 30,000, 20,000, then 35,000, and finally 15,000. So copy all of that and you can paste it here. So when you add, it has to come to 20,000. So this is how the 20,000 fixed cost has been added to the total fixed cost. Okay, so we have to remove this. If you remove this, we'll get the relevant cost of sale fixed cost, that we'll get. Okay, so we'll get that. So this is the relevant fixed cost. So take this number and we'll put it here. So that's about it. So this is like the product specific fixed cost. and there is a common fixed cost of 20,000. Okay, so we had to split that only, that's why it is taking such a long time. So this is working note number 1, and from where we got this, we have to mention it. It's working note number 1. So next is, so this part is over, and if in sales is increasing, he says by 25%, then this fixed cost will also go up by 30%. So we are not bothered about that now. The selling overhead comprises a fixed cost of 5,000 per product plus a variable cost which varies in proportion to the sales value. So now they tell that there is also a, in selling, there is a variable component and there is also a fixed component. Okay, so to do that, we have to get a working note. We have to do a working note. So let's see. So working note number 2 we have to do, and that's going to be selling variable cost. And also there's going to be a selling fixed cost. See, selling fixed cost is 5,000. That's what they say. For each product it is 5,000. So we can copy from there. So this is not a common cost. Okay, it is for, sorry, it is not a common, it is not a common cost. It is specifically for each product, so we can't put it here, and this will be fixed cost. Okay, so we'll move on to this one. So the total selling cost is, we have to get the number from the above. It's going to be 8,000, 7,000, 8,500, 6,500. Okay, and the fixed component, fixed part of the selling cost is here. So this will give us the variable cost component of the selling cost. Okay, so direct both. So we got it. So we can now go to this part and we can type. Okay, so we have split the variable selling cost into fixed and variable. Okay, that also we have done. And he says plus a variable cost which varies in proportion to sales value. Okay, so I think it should be like varying with respect to the sales value only. Let's see. So 30,000 is 3,000, 20,000 is 2,000, 3,500 is 3,500, 15,000 is 1,500. So it is, I think it is like 10% of the sales value. So that is like matching perfectly. And the last part is the fixed cost is not specific to any product, but the sales director believes that it should be shared equally by 4 products. So this 20,000 is not at all a relevant number. Okay, it's not a specific fixed cost.